Welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Unpacking Form 990 PF, a deep dive. We're pleased that you've joined us today, and before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have a couple of great presenters with us today from Moss Adams. We have Pam Alexanderson, Director, and Maggie Elliott, Senior Manager. Their bios and contact information are located in your webcast console. And now I would like to turn the floor over to Pam to get us started.
Okay, well, hello, everyone. Thank you for attending the webcast, Unpacking Form 990 PF, a deep dive. Our agenda today is to talk a little bit about excise taxes, an unfortunate part of private foundations. Then we'll go into some grant-making requirements, expenditure responsibility, excess business holdings, and then if we have time, we will open it up for some Q&A. Just a little note on the agenda, what we're trying to do here is really go into some deep technical subjects that you will likely need to report on your 990 PF. So this is not necessarily a basic class, but we will try to do a deep dive on some of the more technical subject matter for private foundations. Okay, so I'm going to start with private foundation excise taxes, everyone's favorite subject, I'm sure. So the Internal Revenue Code imposes excise tax on private foundations, potentially foundation managers or other disqualified persons for prohibited acts. And you can see on your screen we have 5 of those listed for you, and we're going to do a little bit of detail on each one. These 5 areas are governed by Internal Revenue Code sections 4941 through 4945. One of the most common prohibited acts is self-dealing between private foundations and their substantial contributors or other disqualified persons. And we'll go into some detail on definitions of some of these terms as well. Another prohibited act is failure to distribute income, otherwise known as the 5% distribution rule. And then other areas of trouble are excess business holdings, jeopardizing investments, and taxable expenditures. And we'll discuss each of these today, but more importantly, we want to talk to you a little bit about policies and procedures that you need to have in place to avoid these items. So here's a quick reference guide for you on the various excise tax. This shows a two-tiered tax level, which unfortunately does apply to some private foundations if you're subject to these taxes. The initial tax is levied upon the Prohibited Act occurrence, so at the time the Prohibited Act happens. And then the additional tax may be assessed if the prohibited tax is not corrected during the correction period. The correction period begins on the date the prohibited transaction occurs and ends 90 days after a notice of deficiency for the additional tax is mailed. I've been doing this about 15 years. I've actually not had a client receive a notice. So we've never actually entered that correction period in terms of receiving a notice from the IRS. So I'm sure that that does occur, and some of you may have had some experience with that, but I don't think that it's super prevalent. For self-dealing, the excise tax is imposed on the disqualified person who engages in the act of self-dealing with the private foundation, and 10% of the amount of the transaction is assessed on that disqualified person. There can also be a 5% tax on the amount involved imposed on the foundation manager who participated in the prohibited act up to a maximum of $20,000. Then you can see the additional tax there is significant. It can go up to 200% of the amount involved on the disqualified person, and then 50% on the manager, also up to $20,000. And then some of the other taxes on failure to distribute would be 30% of the amount involved on the private foundation. And then if you're subject to that additional tax in the correction period, it's 100% of the prohibited amount. For excess business holdings, it's 10% of the amount on the foundation and 200% on the additional tier. And then jeopardizing investments, 10% on the private foundation. This is another one that can be assessed on foundation managers of 10% or up to $10,000 per investment. And then the additional 25% on the foundation, and an additional 5% on the manager up to $20,000. And then the last one we have here on the slide is taxable expenditures, which is 20% on the private foundation. It also can be assessed on the manager of 5% up to $10,000. And then the additional tax would be 100% on the private foundation, and then 50% on the manager up to $20,000. So as you can see, these taxes are quite significant, and they're even fairly significant on the initial tax, but you certainly don't want to enter the additional tax scenarios there. These taxes, when you are subject to one of these, you will have to report those on your 990 PF, but then the actual tax is calculated and paid via a Form 4720. Okay. So let's talk a little bit about who a disqualified person is. And these are people who are in a position of influence over the foundation. So all substantial contributors are disqualified persons. And the definition that the IRS has for this is that these are people who give more than $5,000 to a private foundation if the amount is more than 2% of total contributions received by the foundation from the date of creation of the foundation through the close of the tax year in which that contribution was received from that person. So you can see that it's extremely important to keep good records from inception of the foundation all the way through the most recent taxable year in order to really understand who your substantial contributors are. If you're an older foundation, that $5,000 threshold probably goes out the window pretty quickly, and then you get into more of the 2% of total contributions and an amount above that. If you're a newer foundation, you may need to pay attention to that $5,000 threshold. A substantial contributor generally does not include another public charity or governmental unit. Foundation managers are also considered to be disqualified persons. And then you can see here on the slide that family members of disqualified persons and entities controlled by disqualified persons may also be disqualified persons. And then for purposes of control, it's defined as owning more than 35% of the voting power of a corporation or 35% of the profits interests in a partnership, or more than 35% beneficial interest in a trust. So this can get complicated pretty quickly to keep track of who your disqualified persons are. So again, having really good records of who all of your contributors are, potentially what businesses they own, who their family members are, and how you can relate that to the actual donor is a tricky thing to do, but something that that you definitely want to have procedures in place for. Okay, Amy, we have our first polling question.
All right, thank you. So the first question is, a disqualified person is not, and then your options are a substantial contributor, a foundation manager, or a foundation accounting staff. And the polling questions are located right on the slides that we're presenting. So if you can't see it, just hit F5 to refresh your console. And then to respond, click the button next to the answer you choose, and then make sure to hit that submit button.
And this is not intended to be a trick question, but some people may see it that way.
All right, here are the results.
Okay, so most of you got it right. A disqualified person is not a foundation accounting staff. A disqualified person will be a substantial contributor and likely a foundation manager. I guess the trick part of this question could have been that, you know, maybe a foundation accounting staff is a large donor or a family member of a large donor. So, so it is possible that somebody that works at the organization, you know, either through their own donations or through their family members could also be a disqualified person. But on the surface, somebody that just works for the foundation and isn't in any position of control would not be a disqualified person. Okay, so I'm going to turn it over to Maggie. Did I go too far, Maggie?
No, you're good.
Perfect. Okay.
Thank you. So now that Pam has gone over the definition of disqualified person, I wanted to tie it back to the Form 990-PF, where one category of the disqualified person is addressed under Question 10, Part 6A. And if the answer to this question is yes, the foundation is prompted to attach a schedule listing the names of these contributors in the year that they arise. And as Pam mentioned, it's important to keep track of all the historical information, but also current year. And then note that the same information plus details regarding the gift are provided in Schedule B. Also, foundation managers that are substantial contributors are also listed in Part 15. The next slide goes into detail of what a substantial contributor is.
Oh,
we
sorry.
Go to the next slide.
There you go. Whoop.
There we go. So substantial contributor. So the definition implies a person, but it can be, of course, an individual, but it also could be a trust, a state, partnership, LLC, association, or a corporation. As Pam already said, it's anyone who contributed or bequeathed more than $5,000 to their private foundation, if that's more than 2% of the total contributions and bequests received since inception. And with private foundations, what we often see, it really will depend on your organization and how it functions and how it was set up, you know, how much work these substantial contributors take. In a lot of organizations, there's a one-time founder donor who, of course, would be a substantial contributor,
and then that organization goes on and just operates based on the profits it receives from that original donation. In some instances, we have contributions every year, and that's really when it becomes important to track those cumulatively, so you have an idea of what threshold and how much someone would have to contribute to kind of cross that line and become a substantial contributor in a given year. Obviously, as the time goes on and contributions grow, it's harder and harder to reach that threshold. But once someone is a substantial contributor, they're always a substantial contributor. Generally, the rules to sort of become, lose that title are quite complicated. So I generally have not seen anyone lose that title. And of course, the creator of a trust is always a substantial contributor, regardless of the amount they've actually contributed. Next slide, please. So part 6, A, lines 11 and 12. Question 11 in particular pertains the taxability of payments the foundation receives from a controlled for-profit subsidiary in the form of interest, rents, royalties, or annuities. And that question really gets at items that may be subject to unrelated business income tax. So that's kind of unrelated to the substantial contributor, but a area to pay attention to, followed by question 12. If answered yes, of course, the instructions should also be looked at and studied, because transactions of this type may also result in self-dealing. So if a distribution was made from the foundation to, let's say, a donor advised fund over which the foundation or a disqualified person had advisory privileges, then in an attachment, you would state whether the foundation treated any such distribution as qualifying distribution and explain how the distributions will be used to accomplish its exempt purpose. Essentially, this is, again, sort of IRS's way of asking questions to make sure there's no self-dealing. And as many of you may be aware, there's some scrutiny, especially with donor advised funds lately, and there's been proposed legislation that has kind of gone nowhere as of right now, but they are trying to ensure that some of those funds that may go between a private foundation to a donor advised fund within the realm of same families, individuals, or businesses actually do get spent out into communities and into missions and purpose, as opposed to just being moved around to meet, let's say, the minimum distribution requirement for a private foundation. Next slide, please. So section 6, part B series of questions ask whether the foundation has violated any rules that may cause it and its managers to be penalized. As we know, a self-dealing transaction results in an imposition of an excise tax on the disqualified person who engages in the self-dealing transaction, and may also be imposed on the foundation managers who knowingly participate in any acts of self-dealing. Part 6B, line 1A4, so compensation or reimbursement of expenses of a disqualified person. We see this often checked no, which could actually be incorrect. So, for example, if a salary is paid or travel expenses are reimbursed to a chief executive officer who is a disqualified person, but that compensation is reasonable, that's an exception. So often 1A will actually be checked yes, and then you would check 1B no, saying that there's an exception to sort of the act that would suggest it may be self-dealing. Self-dealing is it could be direct or indirect, and I believe we're going to go to the next slide, please. And here's some examples. The next few slides are going to give some examples of these acts. So for your reference, I won't go through every single one in detail, but I just wanted to highlight a few that we see commonly. So a disqualified person cannot sell property to a private foundation. Often we have clients that come and say, well, I will sell it at a discount or below fair market value at a really big deal. It really doesn't matter. Even if you were to sell something for $1, that's technically self-dealing. Donating property is totally fine as long as there's not a mortgage or some kind of debt encumbered with that property. As soon as there's debt, that's something that should be more carefully studied and discussed, as there could be implications from that. The disqualified person or their businesses, which would be also disqualified persons, may rent office space to a private foundation, but again, it has to be free of charge. And also any loans, again, sort of it would have to be a known interest loan. Anything with regular interest or even below market terms would not be acceptable. Another question that we also gets brought up often is fundraising events, tickets. Let's say you're a president, board member of your foundation, and you got invited to a gala, and you just can't make it, but your spouse can make it and your daughter, and they're not at all involved in the foundation. Well, that's not okay. You may attend as the president and representing the organization, but your family attending the event who would not be board members is not okay. Next slide, please. So some additional examples on grants, and that's another one that comes up often because a lot of people who have private foundations are charitably inclined, and so they may, make a grant to a public charity, the same public charity that the private foundation makes. And so it's just really important to be careful that the private foundation's grant to a public charity, for example, is not to fulfill a pledge made by the disqualified person in the first place. It's also important to make sure that making a grant to a public charity, you should not be earmarking the funds for the benefit of a disqualified person, their children, family members, and of course, any gift of cash to a disqualified person that was not included as taxable income and was more than the value of services provided to the foundation is also not okay. A token gift such as flowers, anything really valued $25 or less, which would be considered de minimis, would be acceptable. Next slide, please. And here, Amy, we have yet another polling question.
All right, thank you. So the second polling question is, an act of self-dealing may include a grant made by a private foundation to a public charity to fulfill a pledge of a disqualified person. And then your options are no or yes. And while you're responding, you do have the option to submit questions for the presenters in the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the actual webcast, we will do our best to follow up with you. All right, here are the results.
Thank you. Most of you have gotten it correct. An act of self-dealing may not include a grant made by, or an act of self-dealing would include a grant made by a private foundation to a public charity to fulfill a pledge of a disqualified person. So sounds like most of you are paying attention. Next slide, please. And so here are some exceptions that we commonly see. A lot of times there are transactions between private foundation and disqualified persons. A common one when the transaction itself and the status arises from the transaction is a bequest from an estate. And so assuming that estate, for example, or that individual was not a disqualified person and they become a disqualified person as part of the contribution, i.e. become a substantial contributor, it is not a self-dealing transaction before that occurs. Also, transactions with a former disqualified person would not be self-dealing. Of course, furnishing goods, services, or facilities to a private foundation that on basis that's no more favorable than they would be to general public would also not be self-dealing. And for example, a lease of property by a disqualified person to a private foundation at no charge is not considered to be an act of self-dealing, even if the private foundation pays for, janitorial services, utilities, or other maintenance costs it incurs for the use of the property, so long as the payment is not made directly or indirectly to a disqualified person. Next slide, please. And so, of course, should any of these acts occur, they are prohibited and they should be corrected. So here, the next couple of slides just go through each section and discuss in more detail correcting each prohibited act. Of course, in case of self-dealing, it's undoing the transaction to the extent possible. And essentially what that means is placing the private foundation in a financial position not worse than it would be if that event or act did not occur. So if there were some funds exchanged, for example, they would need to be returned. And depending on the time that it took to return those funds, it would not be unreasonable to also assess some interest on that disqualified person that would pay foundation, for example. And so if you fail to distribute, of course, you would have to make up and make sufficient qualifying distributions with excess business holdings, as well as jeopardizing investments, which are on the next slide. It's, again, getting out of those investments and getting back to the right position there. And next slide, please. And of course, in case of taxable expenditures, would be recovering part of all of the expenditure to the extent it's possible. We completely realize if, for example, you give a grant, and we'll get into grant making here shortly, and it's a prohibited act, it can be challenging in times of getting those funds back, of course, depending on timing. So again, it's really depending on the act. You really have to think through how, if it were to occur, how it needs to be corrected, and do your best effort to correct it, as it will have to be explained. The correction itself would have to be explained on the Form 4720. And I think with that, I will turn it back to Pam to cover grant making requirements.
Okay, thanks, Maggie. Okay, so we're going to talk more about excise taxes. So there are also excise taxes that are impacted by a foundation's grant making procedures. And so I'm probably going to be a broken record, but I really can't stress enough to make sure that you have the proper policies and procedures in place to make sure that you're distributing your money to qualified organizations, or that you are following proper procedures if you are not, so that you don't have to pay yet another excise tax. So if a foundation doesn't distribute to a qualified organization, which are generally 501c3 public charities, we'll go through that in a little more detail here shortly, but a qualified organization, generally 501c3 public charities. So if a foundation doesn't distribute to one of those organizations, it will be considered a taxable expenditure unless expenditure responsibility is completed. And that's yet another IRS term that we will also go into more detail on. As a double whammy to this, that grant won't be considered a qualifying distribution either unless that expenditure responsibility is taken. So if you have an organization that gives a significant amount of money to another organization that would not be considered a qualifying organization, and you don't follow the proper procedures, then you've got a double whammy, not only of a taxable expenditure, but also you don't get credit for that qualifying distribution. So really important to have those procedures in place, and make sure that all of this information is well known by your staff at the foundation. so that you can avoid these unnecessary taxable expenditures. Okay, so some other taxable expenditures include amounts paid to carry on propaganda, influence legislation, and that does include both direct and grassroots lobbying. And then taxable lobbying expenditures so there are some lobbying that you can do without incurring a taxable expenditure. And these are things and amounts paid for certain jointly funded projects that you may be doing with some sort of agency perhaps, or certain program related investment recipients, or certain general support grants, or certain specific project grants. So as you can see, you'll have to educate yourself on what you can do, because again, not all of these even lobbying expenditures would be considered appropriate. So you need to make sure that you know what it is that you're doing, where the money is going, how it's being spent, so that you don't end up in some sort of taxable lobbying situation. The second one there is influencing the outcome of an election. So obviously we can't do that, and probably most of you know from a C3 perspective, political activity is definitely outlawed. And activities that are considered to be participation in a political campaign include publishing or distributing statements on behalf of or in opposition to a candidate, paying salaries of campaign workers, and then conducting or paying expenses of a voter registration drive. Number 3 here is making a grant to an individual for travel or study. So most people, you would think a grant for travel, that probably doesn't sound charitable to most people. But a grant for study does sound charitable to most people. But it's really important, if you are going to make grants to individuals, that you get prior approval from the IRS to do that. The easiest way to do that is when the foundation begins and you file your Form 1023. There's a section in the 1023 for an advance approval process. So that's the easiest way to do that. If you didn't apply for it in your 1023, then you can petition the IRS later. But again, that is more administrative headache and money in order to do that. So making a grant to an individual for travel or study is a taxable expenditure unless that grant is awarded on an objective and non-discriminatory basis. But again, you have to have advance approval from the IRS to do that. And you would also need to keep good records to be able to show that you made those decisions for specific people based on an objective and non-discriminatory basis. The other one is you can make a grant for study as long as it's at an educational institution with regular faculty and curriculum. So, certified universities, organizations that are in place to deliver education on an ongoing and regular basis. They maintain a regular staff. You have to register. There's a certain curriculum attached to it. So obviously, colleges and universities would come to mind as something that you would be able to do. Another grant that you can make to individuals would be as long as that grant qualifies as a prize or award that is excludable from gross income. So you'd have to familiarize yourself with the Internal Revenue Code sections for gross income of an individual, and make sure that the money that you're able to give them is excludable from from the grantee's gross income. And then another grant for individuals that you're able to do is if the purpose is to achieve a specific objective, produce a report, or improve some sort of skill or talent of the grantee. And that would be something that you would certainly want to get some more information from the grantee so that you can really ascertain as to whether that money that you're giving to them is is going to make them better at something. So lots of information that needs to come back from grantees to you as the foundation if you're going to give a grant to an individual. Okay, number 4 on this slide is a grant to an organization, and again, unless you follow expenditure responsibility, which we'll go over here in a minute, but a grant to an organization that is other than a public charity. So here we've got some code sections for you. 509A1 and 509A2 are your run-of-the-mill public charities. 509A1 organizations usually depend on contribution income for their revenue, where 509A2 public charities will depend on a combination of fee-for-service income as well as donation income. So those are your run-of-the-mill public charities. The other public charity is a 509A3. This is a supporting organization, and you can generally give to those, but you need to know what type of supporting organization you're giving to, because you're not allowed to give to what's called a type 3 non-functionally integrated, is what NFI stands for. And so you need to make sure that you know what type of supporting organization you are giving to. There's types 1, 2, and 3. And then within 3, there are 2 types. There's functionally integrated and non-functionally integrated. And then another one you cannot give to is a 509A3, not controlled by a disqualified person of the private foundation. And then the 4th one there is an exempt operating foundation. So a lot of the things we're talking about with respect to this particular presentation really apply to grant-making private foundations. There are some of these things as well that apply to operating foundations, but some of them don't. So, and then obviously a grant that you make for any non-charitable purpose would be a taxable expenditure. Your charitable purposes include such things as religious, charitable, scientific, literary, educational, fostering of amateur sports competitions, or prevention of cruelty to children or animals. That's a pretty common section of the code that you can Google pretty quickly just to make sure you know what things the IRS considers to be charitable. Okay, so switching gears just a little bit on what might be considered a qualifying distribution. So these are the grants and monies that are expended that count towards your 5% distribution requirement on an annual basis. So non-operating private foundations are required to make that 5% distribution as a qualifying distribution of the fair market value of your assets not used for charitable purposes. This is calculated on the Form 990 PF. And again, this is an area that we tend to see mistakes made on in terms of how people are calculating this distribution requirement. It is calculated on an annual basis. But the nice thing is, and we do have some older dates in here, but just to kind of bring it current, if you're currently working on your Form 990 PF for your year that ended December 31st, 2022, you will calculate the amount of your distribution requirement, and you have until 12/31 of 2023 to make those qualifying distributions. So the IRS does not expect you in your current year, if you're again looking at 12/31/22 and your distribution requirement is $1 million, they don't expect you to have to distribute all of that by 12/31/22. They will give you the following taxable year to do that. So as I mentioned before, this is calculated on the Form 990, Part 9. A lot of organizations have excess distributions, so they distribute more on an annual basis than the requirement. And those excess distributions are also shown on the Form 990 PF Part 12 for a period of 5 years. So if you 5 years ago over distributed and you don't use that excess distribution this year, then you lose it. So Form 990 PF, there's also a section, Form 990 PF Part 6B, question number 2. And this applies if a foundation doesn't meet its distribution requirement. And so then that will trigger the Form 4720. And again, this does not apply to private operating foundations. Okay, so a little bit more on qualifying distributions. So as we've talked about in terms of taxable expenditures, as long as you're making grants to qualifying organizations, which are generally public charities, governments, things like that, the amounts to individuals that we talked about that qualify, those are pretty easy to determine as a qualifying distribution as long as you're following the rules. But you can also use expenses that are reasonable and necessary to accomplish the charitable purposes of the foundation, or amounts that are paid to acquire an asset that's used in carrying out those charitable purposes. So if you remember your Form 990 PF, on the first page is all the financial information, and there's 4 columns. Column D calculates your qualifying distributions, or at least the amounts that you should be able to use as qualifying distributions. But column D is calculated on a cash basis, whereas the other columns on Form 990 PF are an accrual basis. And so if you are an accrual basis foundation, you are likely going to have to do some sort of accrual to cash conversion in order to calculate the amounts that you put in column D as it relates to your expenses. So again, these are reasonable and necessary administrative expenses, or they're amounts that are paid for the acquisition of exempt purpose assets. So as you look at your salaries expense that you pay, or legal or accounting, or those types of things that would be considered maybe a little more administrative in nature, as long as you're doing a reasonable allocation, the IRS does not have a bright line calculation for you on that, but as long as your allocation methodology is reasonable, it's something that you use on an ongoing basis each year, and something you can substantiate, then you can take a portion of those expenses and allocate them towards your qualifying distributions. Usually you cannot take 100% unless you can justify that 100% of those expenses are necessary for carrying out your charitable purpose. So have a couple of examples here for if you wanted to look them up and use them. Revenue Ruling 75-495, legal fees paid in a suit to determine the proper beneficiary of part of the private foundation's income would be reasonable. And then a private letter ruling 9623058, reasonable legal and accounting expenses incurred. We just talked about that. In obtaining an IRS ruling with respect to the transfer of assets for charitable purposes. So I always like to ask people, as you're looking at your expense allocation methodology, have the foundation's charitable purpose in front of you to remind you, even though it may seem intuitive, but have it in front of you to remind you, this is what we are on this earth to do as a foundation. Do these expenses meet that purpose? And if the answer to that is yes, then you should be able to allocate some of your expenses towards your qualifying distributions. Okay, so here's some examples of a qualifying distribution. So for grants, as we've already talked about, public charity grants, some supporting organization grants, exempt operating foundation grants. We'll talk about the conduit election here in just a second. And then foreign organizations with the U.S. equivalency determination, not qualified, or organizations controlled directly or indirectly by the private foundation or one or more disqualified persons with respect to the private foundation. Those 509(e)(3 supporting org, type 3 non-functionally integrated would not qualify. a non-operating private foundation without a conduit election would not qualify. And then if you're giving to a foreign org that does not have a U.S. equivalency determination, that would not qualify. Some examples of expenses we've already talked about: reasonable and necessary. Investment expenses would not qualify towards your qualifying distribution. You want to use your investment expenses to offset your investment income to avoid the 1.39% excise tax that private foundations have to pay. Acquisition of assets, as long as those assets are used for your exempt purpose. Again, investments are generally not used for that purpose. Certainly any direct charitable expenditures that you can identify with a specific charitable activity, hopefully that you have defined as part of your mission or purpose. PRI stands for program-related investments, so any current program-related investments would qualify. Repayment of investments would not, and then a lesser-known used item is qualified set-asides. So real quick, the conduit election means any private non-operating foundation that makes qualifying distributions in an amount equal to 100% of the contributions that they've received no later than 15th day of the third month following the close of the previous taxable year. So this is an election that's not used very often, but something that you may want to consider, especially if you grant out early and you grant out 100% of the money that you receive. You can make a conduit election, and therefore if an organization makes that conduit election and you know about that, then you can grant to them as well. Okay, I think we are up to a polling question.
Yes, so the third polling question is: a qualified distribution may include reasonable and necessary administrative expenses. Your options are no and yes. And then just a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions.
Only about 60% of, oh, there we go, 80%. We're getting there. 86%. You need about 20 more people to get your CPE.
And you do get credit even if you select the wrong answer.
Right. Just hit the button.
All right, I'm going to close this out. Here are the results.
Okay. So again, most of you got it right. Yes, a qualifying distribution may include reasonable and necessary administrative expenses, such as the ones we've talked about: salaries, accounting expenses, legal expenses, those sorts of things. So, okay, I'm going to turn it back over to Maggie, and she's going to close us out.
Thank you, Pam. And I do see some questions coming through chat. I'm not sure we're going to have time to answer them live, but please keep them coming if you have them, and we'll do our best to answer them after and connect with you. So diving into expenditure responsibility, the next slide will address when do we need expenditure responsibility. So Pam already talked about this a little bit more. And grant recipients that do not require expenditure responsibility. Pam, next slide, please. There we go. Our public charities, generally supporting organizations, the 501(c)(3)s, of course, with some exceptions. Exempt operating foundations, not to be, of course, confused with private operating foundations. Individuals, assuming you have prior approval or you meet the charitable class requirement. And direct charitable activities. Next slide, please. And so when is ER required? I think this goes back to Pam's point initially. Documentation and having good processes in place are key here for verification. And it really starts from the moment when you award or recognize a grantee, right, to see what responsibility you have, and to ensure that if that grantee is not any of those generally allowable 501c3 public charities where you don't need expenditure responsibility, that this is the amounts actually are spent for the purposes for which the grant was intended. So you have a little bit more of due diligence to do. So your responsibilities that follow the funds to make sure that they're spent for the purpose that they were intended. And so that's where the pre-grant inquiry and grant agreement come into play. And that you also obtain full and complete reports from the recipient on how those funds were spent. And then your responsibility as the taxpayer is to make those full and complete reports to these expenditures on your net Form 990-PF. And so next slide, please. So this is just a quick reference chart, and I won't go through this in detail. Hopefully it will be a good reference point for you to see when expenditure responsibility applies. One call out here I wanted to make is newly formed public charities. We get this question a lot. Those organizations that just submitted maybe their tax-exempt Form 1023 application and haven't received a ruling. Generally, we would advise that you follow expenditure responsibility. In those cases, just because in case they don't receive their 501c3 public charity status, then you would be doing a prohibited act. And so it is better to just do the expenditure responsibility. If that grantee in the future comes back and shows you their IRS determination letter, you could stop doing expenditure responsibility for them in the future. Next slide, please. So tying this back to the 990-PF again, Part 6B, lines 5A, the question 3 addresses whether a grant was given to an individual. So answering that yes potentially would trigger some things. And then question 4 asks about grants to organizations, and answering that yes, of course, would also need a further explanation, and that's where the expenditure responsibility statement would provide required details, and we'll go over those in the next few slides. So the next slide talks about reporting to the IRS. And so, as I mentioned, a granting foundation must provide this information on its annual 990-PF for each taxable year with respect to each grant made, so a separate statement for each grant made during the taxable year that's subject to expenditure responsibility. And your next responsibility is to follow that grant until the funds are fully expended. So if $50,000 is awarded during the year and $50,000 is spent, it's a one-time expenditure responsibility statement. If only half of those funds are expended in 1 year, you will have to report that next year and keep updating for that grant. With respect to any grant made for endowment or other capital purposes, the grantor must provide the required information only for any taxable year for which the grantor must require a report from the grantee. So there are some nuances with capital and endowment grants. Next slide, please. So the report, what should this report include? So the name and address of the grantee, it would be match up really with Part 14 where grants are listed, the date and amount of the grant, its purpose, the amounts that have been expended during the year, and any most recently received report from the grantee. Typically it's the date, and please know if you give a grant, let's say it's 2022, you give a grant in 2022 and you don't receive the report till the following year from the grantee, you're technically, and you may still be working on that 990-PF that might have not been finalized and filed, you're not actually required to include that grant report from the following year. You could wait till the next year. Although, of course, if you have that information, you could include it. And then the dates of any reports received from the grantee, and dates and results of any verification of the grantee's reports undertaken. And so typically we don't see that come up too often, any diversions or verifications. But of course, should a foundation be questioning how those funds are spent, you would want to explain how you verified that the funds were spent for the purpose that they were intended for. Next slide, please. So going back to the original comment I made and having these good processes in place, so for your internal purposes, a copy of the agreement covering each expenditure response you grant is critical. Copy of each report you're required to keep from each grantee. And with that, you just want to make sure that in case you were to be audited and some of this information was required, that it's all nicely stored and easily trackable of, how you verified, what steps you took, and what information you have. And with that, we'll have our last polling question.
All right, thank you. So the fourth question is, evidence of expenditure responsibility for a taxable expenditure is reported to the IRS, and your options are by mailing a copy of the expenditure responsibility report within the Form 990 PS for the grantor, or within the tax return for the grantee. And while you're responding, for those of you that would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts. And then we're also sending them out via email tomorrow, along with the recording of this webcast. And for the sake of time, we'll just leave this up another 5 seconds or so. All right, here are the results.
Thank you, Amy. And most of you got this one correct. So it would be within the tax return for the grantee. And our last section here today, which we have only a few minutes left, is regarding excess business holdings. This chart that's in front of you is honestly my go-to. I think it's a great visual of when excess business holdings come into play. And so if you own 2% or less of an investment, it's considered de minimis, and you really don't have to worry too much about that investment. Where excess business holdings come into closer consideration is when disqualified persons also own or control those businesses and have voting stock. And there's two different thresholds there, the 20 and 35%. And of course, the 100% that Newman's own is its own special rule that was effective 2018. And Newman's own fought very long and hard to have this passed. We have not seen too many other organizations follow, but it'll be interesting to see what happens in the future. And so going over the definition of what business enterprise does not include. So a trade or business that derives at least 95% of its gross income from passive sources. So great example of that is, investment in a real estate partnership, right? It's a rental business. It's completely passive. That's not a business enterprise. A functionally related business, an activity related to the exempt purpose of the organization also wouldn't be a business enterprise. A bond or other debt obligation issued by a corporation, of course, unless it's reclassified as equity, and then warrants, rights, and options to acquire stock or other equity interests would not be business enterprises. And again, tying it back to the 990 PF, the Part 6B, lines 3A and 3B is where this question gets addressed. So 3A asks about the 2%, and that may be answered yes. You may have more than 2%. But hopefully 3B is answered no, and that you actually aren't in excess business holdings situation. And so the last slide really talks about disposal rules. Similarly to any of these prohibited acts, if you come to find out that you have excess business holdings, the disposal rules are displayed here. And so tying it back to, Pam's main point, really maintaining a current list of all the disqualified persons for closely held stock and establishing a procedure to monitor any of these changes, having conflict of interest questionnaires as you get new board members or new officers or managers is really critical to make sure that you're staying within these lanes and not violating any of these rules. And with that, I will turn it over to Amy to close.
All right. Thank you, Pam and Maggie, for a great presentation today. We are out of time, but to our audience, if you have further questions or comments, please reach out to us and we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Pam and Maggie directly. Their contact information is in your console and in the slide deck. And then I also want to draw your attention to the image in the upper right-hand corner of your console. If you click on this, you will be taken to information for our upcoming virtual private foundation conference. A CPE will be offered and registration is open, so check that out. And then if you met all CPE requirements, your certificate is available to download now in the CPE progress window. And finally, here's a link to a survey for today's presentation. And thank you for joining us. Take care, everyone.